crypto staking has become a lot more popular in the last few months. So it's important to understand how the tax works on that. So let me explain today how the tax works on crypto staking here in Australia. Hello everyone, my name is Ethan Rushock, and as I just said, I'm going to be explaining how tax works on crypto staking, which is really important if you're getting involved in it, because you need to have all of this tracked from the start, otherwise you're going to cause yourself a big mess when it comes to tax time. So just quickly, for those that don't know, crypto staking is pretty much where you're staking your coins that you own, and it's a proof of stake method, so you're receiving rewards back in return, and they normally come in the form of a coin. So obviously straight away here, you can see you're receiving some type of income or some type of asset, and therefore that could be a potential taxing point. So let me explain how that works, because there's a couple different taxing points during this process. And also always, if this is your first time here or you haven't hit that subscribe button yet, please hit that, because it really helps me grow this channel. I really enjoy speaking to you and I really enjoy making these videos, so your support goes a long way. So as I said, we've got two different taxing points. We've got an income taxing point, which is going to be when the crypto reward is received, and then we're going to potentially have a CGT point, so a capital gains point, when the asset is later sold. Now the good thing is that it's not a taxing point when you first stake the coin. So let's say we've got a Binance coin and we've staked it, and we've had that coin that we purchased for an initial value and it's grown in value. When we stake it, that's not a capital gains event. Now the reason for this is if you're still the beneficial owner of that asset, you've never transferred that asset to someone else. So you still own that asset, you still own all the future income to it, you still own the future rights to it, therefore it's not a capital gains point. Now if you go sell that at a later point, that will be the capital gains point. Now if you haven't watched my video on capital gains tax on crypto, make sure you go check that one out, because it's really important that you've got an understanding of that before you start looking into these different types of crypto income and how they work, because if you don't understand the capital gains point, you'll really struggle with this stuff. So first, let's talk about the income side. So this is when you receive your staking reward. So we'll use an example because that always makes things a little bit more simple. So say we end up receiving one BNB, so one Binance coin, as our staking reward. Now let's go, this has an Australian dollar value of $350. So this is going to be our taxing point. So we have $350 of income that needs to be recorded on our tax return. So think of it a little bit like bank interest. When you receive interest on your money that's invested in the bank, you receive your interest and that makes up the income. Now this is going to also form the cost base when we talk about the CGT point later on. And obviously it's going to depend how often you're receiving this income as to how many times this is going to happen. So if you're receiving fractions of coins through the year, each of these is going to be an income point, and it needs to be converted to Australian dollar value on the day you receive it. At the time you receive it is so important. So you can see why it's really important to be using some kind of crypto tax software to track all this. So again, check out my video on CoinLeak, coin tracking. They're really good softwares that makes this much simpler. So this income side of it is pretty easy when it comes to tax, because you're receiving a reward. It's received in the form of an asset, not necessarily in the form of cash, but you need to convert that asset value at that date to Australian dollars to record it in your tax return. The biggest challenge, like I said, is this could happen potentially 365 times through the year if you're getting a staking reward every day. So you need to be keeping track of that along the way to make it much easier when it comes to lodging your tax return. Now the other taxing point is going to be a potential CGT event. So we'll use that same example of that one BNB coin we received. So we received that at $350, and say in 6 months time we go, you know what, I want to sell that, and it's now risen to $400 Australian per BNB. So we go and sell that coin for $400 now. So we have now got another taxing point here because we've made a capital gain of $50. So we're going to recognize the initial cost base as the $350. That's what we paid that income tax initially on. And now we've got a $50 capital gain that we're going to pay tax on. So all we're going to have here is $50. So we've had $350 initially that we're going to pay tax on, and then $50, which, you think about it, you received this for nothing as such. You received this by staking your coin. Therefore, eventually you're going to pay tax on all of this. You're not paying double tax, because you're just paying it at two separate points. Now the reason for this, and this is where people get a bit confused, they go, well, why should I have to pay tax? I've already paid tax initially. The reason is you've chose to receive that reward as such, and you received it at that value, which we talked about. But you've chose to keep it in that asset, and therefore you've chose to keep it for the potential gain period. So you've now made a gain on that asset. So it's no different to you having bought one BNB coin for $350. Instead, you received it as a reward, you've held it, it's gone up in value, and therefore you're going to pay tax on that gain. So it's quite simple with crypto staking, and how the tax works. It's just we have two separate tax events. We've got the income event, and then we've got the potential CGT event. Now, obviously there's some things that go into this that I haven't spoke about, like potential losses that might be able to offset some of this CGT. Now, something to be aware of, which I say would be the worst case scenario, is you receive that initial reward, say that $350, but now the assets drop down to $150, and we end up with a loss here, and it's going to be a capital loss that won't offset that staking income. It can only be offset against other capital gains. So that's just something to be aware of when you're trying to do a bit of planning for tax. Now, speaking about planning for tax, don't forget I do offer some crypto tax packages through my business, Rushock Accounting. So I'll bring them up quickly here, but definitely get in touch with me if you need help with any of your crypto tax. So whether it's just lodging the tax return, or whether it's help trying to fix up Coinly or coin tracking or whatever software you're using, get in touch with me and I can talk to you about how I may be able to help you. I hope that video has been helpful. I hope it's explained to you in simple terms how the tax works on crypto staking. I'm going to be covering more crypto topics in the future, so keep an eye out for those videos. I thank you for watching and I'll talk to you again soon.